a once simple portfolio allocation that was able to provide 9% annual return since the year 1928 and outperform even the smartest of investors is officially dead. In this video, we will discuss why the 60-40 balanced portfolio will fail to provide the types of returns we have seen in the past. Hey, it's Nick here from Ways of Wealth. Thank you for tuning in. If this is your first time here, we highlight key events that happened in the market over the past week. And before we jump right into the video, I'd like to ask you a huge favor. If you learned something new, if you get some value out of this video, hit the like button. It definitely helps my channel out. For videos every single week, don't forget, hit that subscribe button, turn that notification bell on, and it'll alert you when the new videos are live. So the 60-40 portfolio is one of the simplest yet most effective portfolios that have stood the test of time. If you're not familiar with what this is, it's simple because it only involves two different asset allocations. The first asset allocation is in stocks, 60% of which are in an index fund like an S&P 500, something that tracks the overall broad market and diversifies while participating in growth. The other 40% is in bonds, normally US Treasury bills, whether that is the 10-year or the 30-year. The portfolio worked in a way that you had a portion of it, 60%, that was participating with the growth of the economy, and the 40% was supposed to be a backstop to protect yourself during market downturns and getting that yield that was supposed to be an income for the portfolio. If we take a look at the performance of this portfolio from the year 1980 to 2020, we can see that only 5 out of the 40 years had negative returns, whereas on a positive note, in 22 years out of the 40, it had a double-digit return. Now you're probably wondering why I'm calling this dead. And there's a few different factors of concerns on both the stock and the bond side that we'll look into now. Let's start with the 40% allocation in bonds. As mentioned before, it is typically US Treasuries, but as of late, we've started to see more corporate bonds added into the mix. And here's where the problem is in the short run. As of Friday, you had the 10-year Treasury close at 0.82 basis points or 0.82%. On the 30-year, you saw it close at 1.59%. And these are the return, this is the yield that the portfolio is gaining. These are all-time lows. This means that the yield that you make from the bond is essentially netting you potentially zero or negative if you factor in inflation or any expense ratios, MERs that you're paying on an ETF, not to mention a fee that you are paying to the financial advisor. There are also long-term implications of having such a low yield, and that's essentially that these yields will have to rise. And yes, this is a positive for the income of the portfolio in the future, but a negative for the overall portfolio value. This is because the inverse relation between bond yields and bond prices. So if a bond yield increases, then the price of a bond will go down. And then that will be reflective of the 40% of your portfolio that is allocated to bonds, bringing the total value of the portfolio down. To put this into context, the 30-year US Treasury bond that we talked about earlier in the video that closed at a yield of 1.59 on Friday averaged 5% over the past 30 years. So this increase in yield will come from inflation. And this is what the Federal Reserve talked about, letting that run a little bit hot. And I talked about this in a previous video about how inflation is coming. And I would definitely suggest checking that video out. I will link it above. Up next, let's discuss the 60% of the portfolio that is allocated towards stocks. And there's some bearish arguments surrounding the stock market and the current valuations that these companies are trading at. And this can be justified by looking at the Buffett indicator. If you're not familiar with what this is, it's a ratio that compares the total value of the US stock market in comparison to the GDP. The last time it was at these levels was in the 2000 tech bubble, and we all know what happened after that. There's also another argument that stocks really never got cheap back in March. They were just able to come back down to fair value, and now since March, these stocks have continued this crazy run that they're on and trading at crazy price to earning ratios. Another part of the bearish argument follows in the fact that the economy is slowing. We're not growing like we used to grow, and we're kind of following in the same path that the Japan economy has been through, and as of late the European Union and what the EU is doing in terms of the GDP growth. And that's kind of a concern for stocks, and that won't provide the same type of returns that they provide over its history. I personally am not that bearish on the market. I do see opportunities in high value dividend paying stocks that haven't quite seen the love that other sectors like maybe the tech sector is seeing. But in reality, with bond yields so low, these hedge funds and pension funds need to get the yield from somewhere, and the perfect opportunity to do so is to get into the stock market and find these dividend paying stocks. Obviously, everybody's portfolio allocation should be specific to your own risk appetite, and I definitely suggest figuring out what makes you tick and what your expectations are. But for me personally, I've decided to put the bond portion of my portfolio aside and have actually kept it in cash, anywhere between 0 to 20% in cash. And what I do is I take advantage of opportunities, buy the dip, or find undervalued companies that I think will come back. And that's what I've been doing to kind of evade the problem of the bond yields. I definitely think that that's more of a focus. I'm still bullish on the economy, bullish on stocks, but I think the bond yields need to correct and come back a little bit further. So I hope you take this advice, look at your own portfolio, make your own decision, and figure out what works best for you. That's all for this week in the market recap. I hope you guys enjoyed the video. Again, if you made it this far and you got some value, please hit the like button. It definitely helps my channel grow. And don't forget to hit the subscribe button, turn the notification bell on. We do this every single week. I hope you all have a great week in the markets. Happy trading.